Stop panicking about Tesla's drop. Seriously. If you saw 37% wiped out and thought this is the end, you haven't looked at Tesla's history. Here is the counterintuitive truth that every Tesla investor needs to understand. Tesla is down 37% from its 52-week high of $489.88. It trades at $308.85. Worst performing Magnificent 7 stock this year. Two things are hitting the stock simultaneously. First, China spin-off uncertainty. The Wall Street Journal reported Tesla is considering separating its China business to pave the way for a SpaceX merger. Elon Musk called it fake news. Second, fundamental pressure. Operating margin fell to 1.4%, free cash flow turned negative $1.09 billion, and CAPEX is set to exceed $25 billion. But here's the catch. Tesla's historical record shows that buying at 52-week lows has been profitable 3 out of 3 times. Let me break down both stories. I'll admit something. I saw Tesla down 37% and thought, is this the beginning of a 74% crash? Then I looked at the historical data, and I realized, Tesla has been here before, 3 times, and rebounded every time. Today, I'm going to break down the two stories hitting Tesla. By the end, you will understand why this is a critical moment, and why history suggests the worst might already be priced in. Stay with me. Let's start with the first story. The Wall Street Journal report, Tesla is considering separating its China business, a move that could pave the way for a merger with SpaceX. Advisors have weighed options including a spin-off, outright sale, or even shutting the unit down. Why this matters? SpaceX is a major U.S. defense contractor, handling sensitive national security work. Tesla runs fully owned factories inside China. A merger would raise regulatory red flags on both sides. The solution? Splitting off the China unit would build a firewall between that business and Tesla's American operations. Musk's response? Fake news, on X. But the reporter's point? Just because somebody says it's fake news doesn't mean it didn't happen. The denials are not necessarily the final word. How important is China? It's the second largest market after the US. The Shanghai factory produced over half of global deliveries in 2025. Capacity beyond 950,000 vehicles a year. Over 4 million China-built vehicles crossed in December. The counterintuitive truth. Even if the spin-off is fake news, the fact that it's being discussed shows how serious the SpaceX merger considerations have become. Now let me show you the fundamental picture. Q2 2026 results. Revenue was $28.24 billion, up 25.5% year-over-year, beating estimates. EPS was 33 cents, missed estimates of 50 cents. Deliveries hit 480,126, a record Q2. Operating margin fell to 1.4%, down from 4.1% a year ago. Free cash flow was negative $1.09 billion. CAPEX more than doubled sequentially and is expected to exceed $25 billion in 2026. Why the margin pressure? No repeat of the prior quarter $230 million warranty benefit. Higher interest rates with subvention costs recognized upfront. Energy gross margin fell sharply due to vendor warranty true-up. The investment story? Tesla is in its largest and most exciting period of investment. CAPEX will grow for 2 to 3 years as Tesla expands Robotaxi fleet, Optimus production, AI compute, semiconductor fab investments, and solar manufacturing. The counterintuitive truth. Tesla is trading at roughly 160 times forward earnings. The market is pricing in perfection on AI, Robotaxi, and Optimus, not today's margins. Now let me show you the most important part. Tesla has hit 52-week lows 3 times in the past 8 years. First, in June 2019, split adjusted $11.93. Skeptics questioned demand for the Model 3. 1 year later, the stock nearly quintupled. Second, in January 2023, $108.10 after a 65% drop in 2022. 1 year later, up 120%. Third, in April 2024, $142.05 after the first year-over-year delivery decline. 1 year later, up 68%. The pattern: each time, the market's fear was about demand. Each time, Tesla produced a demand answer. What's different this time? Demand is not the problem, deliveries hit a record. The scare is about profit and CAPEX. The bottom line: Tesla has rebounded from 52-week lows every single time, but never with this thinner margin and this heavy an investment cycle. Now let me be realistic about the risk. Tesla's drawdown record: in the 2020 COVID-19 crash, it fell 61% versus the S&P 500's 14%. In the 2022 inflation shock, it fell 49% versus the S&P 500's 14%. In the 2014 to 2016 oil price collapse, it fell 47% versus the S&P 500's 6.8%. In the 2025 US tariff shock, it fell 38% versus the S&P 500's 19%. The all-time worst was 74% from 2021 to 2023. The average drawdown is 31% across 13 catalogued market shocks. Where we are now, 37% from the 52-week high. The bad case: if the 2021 to 2023 74% drawdown repeats, Tesla could go to roughly $127. The good case: the 2025 tariff shock bottomed at 38%, close to where we are now. The counterintuitive truth: Tesla's average drawdown is more than double the broad market's. But recoveries have happened, ranging from 4 months to 35 months. Let me leave you with the 3 secrets that connect everything we just discussed. Secret 1: the China spin-off trap. The WSJ report is either true or false. But even if it's false, the fact that it's circulating shows the market is pricing in a SpaceX merger, and regulatory complications involving China are the biggest barrier. Secret 2: the CAPEX burn reality. $25 billion plus in spending. 2 to 3 years of heavy investment. Free cash flow negative. Tesla is betting the farm on AI, Robotaxi, and Optimus. If it pays off, the upside is massive. If it doesn't, the downside is severe. Secret 3: the historical pattern signal. Tesla has rebounded from 52-week lows 3 out of 3 times. But this time is different. Demand is not the problem. Margins are. Whether the pattern holds depends on whether margins recover as fast as demand did. So what should you actually do with this information? If you already own Tesla, position size control is critical. Don't have more than 10% of your portfolio in one stock. History shows drawdowns can reach 74%. If you are a trader, $297.82 is the 52-week low. If it holds, history suggests a potential rebound. If it breaks, the next support is around $250 to $260. If you are skeptical, Tesla at 160 times earnings is expensive. Worst performing Magnificent 7 stock this year. Wait for margin improvement before committing. Here is my question for you. Do you think Tesla will rebound from the 52-week low like it has before, or is this drawdown different? Drop your answer in the comments. I read every single one. Like and subscribe if you want more analysis on Tesla, AI, and the companies reshaping the industry. I'll see you in the next video.